so often have intensive asset usage. They produced high volume of goods to sell, but sell them at lower prices. Again, it's the effect of that economies of scale that we've already studied in F1. So what happens is that, yes, there are machines working, but they're working to such intensity that the per unit cost just becomes so small that it reduces our overall cost, right? And secondly, higher margin businesses like luxury jewelry items produce less goods but sell them at a high price. Obviously, their cost is much less, but the profit is much high in this case. Many of these businesses still use very labor intensive rather than machine intensive methods of production. Such crafts are highly valued and consumers are willing to pay premium price for them. Right. So this was the explanation for this relationship. But actually, I would say practically it does not have any kind of explanation. We just have to
Yeah.
remember these formulas, these figures, that what is being multiplied with what thing and what is equal to the answer of this. Okay, right. Okay,
Yeah.
now let's move on to the liquidity ratios, the last two parts, the liquidity and efficiency. Basically, the second part. After profitability, we are starting the liquidity one. So first of all, in the liquidity, the first ratio we've got over here, this is called current ratio. Okay, so this is very simple to understand. It's basically telling the effect of current assets over the current liabilities. It's comparing two things. Okay, now in some cases it's called current ratio as well, and in some cases it's called working capital ratio as well, right? That's why it is only considering the current amounts, not the non-current amounts. We just divide the current assets by current liabilities. Okay, so current ratio measures the adequacy of current assets to meet liabilities as they fall due. Again, this answer is also coming as a ratio, you can see. So let's take an example. Let's say our current assets were 50,000, right? And our current liabilities was just 10,000. This happens
Yeah.
in a very rare scenario, but still I'm taking an example. Okay, and we write ratio 1. So what is the answer over here? It's 5:1, right? So this means that out of every one liability, we can use 5 times the asset of paying one liability, right? That means we can pay off 5 straight away liabilities from the use of all our assets. So this is the meaning of current ratio. Okay, right? So why have they considered again the current amounts? Because they are quickly convertible into cash. And in liquidity, I just told you what does liquidity means, that how quickly the assets are being converted. Obviously, non-current assets will take more time to convert because first we have to use them 20, 30, 40 years, like cars, machinery, vans. They are not quickly converted, right? So that's why it's form of a liquidity ratio. That's why it's taking current amounts over here. Current are usually less than 12 months, so they are converted into cash fairly quickly, like inventory, cash, bank balance, prepayments, right? Receivables. All of these are examples. So a high or increasing figure may appear safe, but it should be regarded with suspicion as it may be due to high levels of inventory. So obviously the amount should not be very high. Like in this case, 5 times is considered very high. It may be because we are holding too much inventory, and holding too much inventory is also very harmful for the business because it may result in, let's say expired products, because too much inventory is there. How can we sell it to the customers, right? Secondly, high cash levels could be put to better use by investing it in non-current assets. Obviously, if the ratio is coming very high amount, so that will represent that cash amount is very high because cash is part of current assets, right? And if cash amounts are high, that is also very alarming because managers will say, shareholders will say that this cash would have been used somewhere else, which was much better, like in positive projects, like in new machinery, new buildings, right? That will generate us revenue. So keeping high cash levels is also not, beneficial in every case. Okay. Now, same things are explained over here as well, the current ratio. We just have to remember that this is the formula of it: current asset divided by current liabilities.
Okay.
Okay, right. Now, let's move on to the next one. The second part of the liquidity ratio. The first one was current ratio. The second one is quick ratio. It's called quick ratio. So why is it called quick ratio? Because it just considers the highly quickly items in the business. I'll give you one example, okay? But in some forms, remember, it's called quick ratio, and in some circumstances, it will be called asset test ratio as well, right? There is no specific explanation why it's called acid test, right? It's a very weird name, but you can remember it like quick ratio as well. right? Because quick ratio considers that how quickly the assets are being converted. Now, in current assets, if you consider, we are just cutting down on the corners. The correct explanation for this will be, we are just cutting down on the corners. How are we cutting down? Because we are converting the current ratio into a more quicker ratio, right? Again, it's a liquidity ratio. So what is the formula? Current asset minus inventory. Now, why is it has minus inventory over here? The reason is that inventory still takes time, right? It's not the quickest method to be sold, right? It's not the quickest. So that means inventory may take 3 months, 6 months, but other things like receivables, cash, bank balance, prepayments, they are readily convertible. Let's say into, let's say 15, 20 days maximum, right? But inventory can take, we can say 8 months, 9 months, 10 months to sell, even 12 months as well, full year, right? So that means we are just excluding the inventory from the current assets and we're dividing it with the current liabilities. Because why are we taking out the inventory? Because it's called quick ratio. Quick ratio
Okay.
just ignores the even the slightest item which are taking a little bit of time. Okay, right? And inventory is the perfect example of the thing which is taking time over here. Now let's read the
Mhm.
explanation. So quick ratio is also known as asset test ratio because by eliminating inventory from current asset, it provides the asset test of whether the company has sufficient liquid resources to settle its liability. So maybe they have kept this name, this asset test, because they are just considering liquidity items. So very highly liquid items will exclude inventory. That's why they're taking out the inventory. That's why it's known as a very quick ratio. Okay, right? So in the explanation, if you read, in every kind of explanation, there will be like normal average figures in the world as well. So the
Yeah.
average figures for this is basically 1:1 to 0.7:1, right? These are the average figure. Normally, it does not, go up than one. It is within one because
Mhm.
current assets cannot, they are not so much high in practical world as well that they can settle off liabilities for a lot of times, right? That is also not practical. So it should be reasonable but in a sufficient amount. Okay, right? So again,
Okay.
all the things are being explained. These explanations you will have to study, and I'm sure you will get them. If there is any issue, you can ask me. Okay. Now
Mhm.
these are we can see, because in the topic we studied, the ratios included liquidity and efficiency both, right? So I would say the first two, the current ratio and the quick ratio, was example of liquidity ratio. Now we are moving towards the efficiency ratio, because from here the efficiency ratios begin. In above topic it was written both at the same way, right? So efficiency ratios begin from this point of time. Okay, so first efficiency ratio is inventory turnover period. Again, turnover means that how quickly the item is being sold out or how quickly it's being finished, right? So this is the meaning of turnover. So this means that how quickly the inventory is being turned over, right? So the formula of this is inventory divided by cost of sale multiplied by 365, right? So this simply measures how efficiently management uses its inventory to produce and sell goods. So it's again an efficiency ratio, right? And every company would want that they use it very efficiently, right? Less inventory is wasted in that case, because if more inventory is
But why
wasted,
divided by cost of sales?
because you see, for every kind of inventory we have to incur some of cost as well, because this is an asset, right? Inventory is a current asset, it is an asset for the company, but cost of sale is like an expense, and inventory is part of cost of sale as well, right? When we studied the profit or loss. So basically, why is it an efficiency ratio? Because the less inventory wastage we have, the less cost of sales we have, and the less cost of sales we have, the more upper amount and the lower denominator amount, the more answer we'll get of this, and that will be very beneficial, right? So we have to multiply it with
Okay.
365 days because it will give us the answer in days. The answer of this will be in days. Okay, because it's the inventory turnover period in days actually.
Okay.
Okay, right? Now let's read the explanation. So an increasing number of days implies that management are holding on to inventory for longer. Again, I told you the literal explanation for the turnover was basically how quickly inventory is being used in the company, right? Let's say the batch of inventory came into the factory on 1st March, and let's say on 4th March it was completely finished. So we can see inventory turnover period is very less. It's just 3 days in this case, because the cycle, the first batch of inventory just got finished in 3 days, right? So this could indicate lack of demand and poor inventory control. But in this example, let's say if the batch of inventory came in the factory on 1st March and it got finished on, let's say, 30th April. So it took approximately 2 months, right? So that means this will result in old inventory as well. And maybe people not liking that product as well. They'll say that it's very old, right? Let's say if it is a clothing thing, they'll say that, the things are chipping off from this. The clothes are, not wearable in good scenario. Alternatively, the increase in inventory holding could be due to buying bulk to take advantage. So these are, factors that we have to consider, that high inventory volume can be because of these items. So reducing the risk of stockouts. The risk of stockouts means that if a customer walks into the factory and it asks that I need 1,000 units, so that we have every time available, we have the inventory available for the customer every time. We don't we are avoiding the stockouts in this case, right? So this way we can avoid the inventory, and this will be very high balance in this case, right? So an expected increase in orders as well, because if we know that the demand is increasing, the orders will be coming more. So in that case, the inventory holding time can be more in this case. So either way, the consequence is that the cost of storing, handling, and ensuring inventory levels will also increase. The more the days we keep the inventory, the more cost will be arising as a part of cost of sales. Okay, so explanation is just for understanding this, but in practical terms, we just have to use this ratio, this formula in actual terms in the exam. Okay, so inventory divided by cost of sale into 365. Okay, now again, this is the explanation of this. Now, second one of efficiency is called receivables collection period, right? So again, this represents that how quickly we are receiving the amounts from the customer. Now, please note, if this time is very less, let's say if it is 1 week or 2 weeks, it's very good for the company. The less the time in this, the good for the company the scenario becomes, right? The more good for the company. The more the time that the company is taking to receive the cash from customers, the bad it is for the company, right? It's very worse for the company, because obviously every company would want that customers pay them very early so that they have more access to cash, right? No company would want that they receive cash, let's say after 2, 3, 4 months, because that will take much time. The formula of this is trade receivables divided by credit sale. So you can see in every efficiency formula, we are using both similar amounts. So in above, we took inventory and cost of sale, because inventory was related to cost of sale. In this one, we took trade receivable divided by credit sale, because receivables arise from which amount? Credit sales, right? So receivables divided by credit sales multiplied by 365. Okay, the ratio shows on average how long it takes to collect cash from credit customers once they have purchased goods. So same explanation, right? So this will be dependent on stated credit policy and previous period figures, right? Now, increasing accounts receivables collection period is usually a bad sign, suggesting lack of proper credit control, which may lead to irrecoverable debts, right? So if
Yeah.
obviously the time is more, let's say the answer is like 90 days, 100 days, which is very alarming for the company. So in that case, there is a huge risk that we run out into the bad debts, right? Because if a customer has not paid 100 days, obviously there will be a reason that he has forgotten to pay, right? And it will be very difficult to chase him now, right? It may, however, be due to a deliberate policy to attract more trade. Yes, some businesses do this, that they give more credit period. They say that other businesses are demanding cash in 15 days. We demand from our customers in, let's say, 90 days, right? So customers will be attracted to the 90 days one, right? A major new customer being allowed different terms. Yes, this can also result in that. Okay, so falling receivable days is usually a good sign that I explained you, because in this case, company is having more access to cash if it's receiving in less days. Okay, this was receivable turnover period. In short, it's called
Okay.
receivable days as well. Okay, here's the explanation. And second one, the third one over here is payables payment period. So this is the again efficiency ratio, payables payment period. Now, in the receivables collection period, what were we considering? How quickly the customers are paying to us. But in payables payment period, what are we considering? How quickly we are paying to the payables, right? Now, this is completely, the implication of this is completely opposite to that of the receivables. Because if you think practically as well, if look, if we're taking more days to pay our payables, that means we have more access to cash. And the motive of businesses is that they should have more access to cash. They have more days to do anything with the cash, right? And in that case, companies can do wonders. They can, invest in different kind of projects. In that case, they can invest in bank loans. They can invest, in companies as well, so that they earn a return out of that, right? So all the general rule is over here is that all the companies want more access to cash in this case, right? So in this, what happens is the more the days it's the better, right? The more the days, it's better for the company. But the less the days, it's worse for the company. Because see, the less the days means that if we are paying the suppliers in just 1 week time, we are just losing cash in just 1 week. We did not even get the chance to do something with that cash, right? It's always, disappearing for the from the company. So this is the meaning of less days. Now the formula of this is trade payables divided by credit purchase. Again, the same thing. Everything we are comparing with like amount, right? So
Yeah.
payables, we are dividing it with the credit purchases. We don't have to include the cash sales, only the cash purchase, only the credit purchases, and multiply it with 365 days, so that the answer comes into days, right? Now the ratio is always compared to previous years. A long credit period may be good as it represents a source of free finance. So the same thing I explained over here, that longer the days, it's better for the companies. A long credit period may indicate that company is unable to pay more quickly because of liquidity problem. Yes, one drawback of this is this as well, the second point, right? If the credit period is long, the company may develop a poor reputation as slow payer and may not be able to find new supplies, right? So in every case, this longer days is not better for the company, because if we are taking longer to, if you consider the drawbacks of this as well, if we are taking longer to pay to the suppliers, it is very, unethical as well, because suppliers will say that we don't want to do business with this customer again, ever again, because he takes ages to pay, right? So everything has a pro and con over here. Okay, right? Okay, now the next topic you can see over here, it's cash cycle, right? Now this, I guess you have studied in F2 exam as well, right? In the management accounting, it's the same thing. So what happens is that we can also consider the cash cycle as part of management of working capital. So you know the meaning of working capital. The working capital is basically the capital we need, the companies need for daily life operations, right? So in effect, it may be regarded as the interaction of inventory, turnover, receivable collection period, and payables payment period. So the thing it is trying to explain over here is that it's a result of three ratios. The first ratio is inventory turnover, second is receivable collection period, and third one is payables payment period. And if we see the formula over here as well, it contains all the three items. Okay, we'll come back to that in just a minute. So the cash cycle is important to a business to ensure that it has adequate cash resources to meet the needs of the business. Obviously, every business, again, remember the general rule, every business needs to have more access to cash in this case. Okay, to pay the current liabilities as they fall due, to meet any financing commitments that business may have, to meet any regular weekly or monthly payroll cost. Obviously, these are all the reasons that the company needs cash in the short term. Okay, so there is a formula
Sorry,
that is,
could you sorry.
yeah,
No, I'm just need to write something.
yeah, sure.
Wait. So basically, it just says that we need to be, then there needs to be like a balance between, what we pay, what we receive.
Yes, exactly. So basically, the business always needs to have some kind of cash, either it's small amount, either it's big amount, but some cash should be available in the business for the short term operations, for daily, you can say the daily life expenses.
Yeah. Hmm.
Okay, right?
Okay, thank you.
Okay, 1 second.
Yeah, I've written everything down so you can go down.
Okay, sure, sure.
Let's scroll down if you want. Yeah.
Okay, so the next formula over here is cash conversion cycle, right? So this probably you have studied in the management accounting as well, and the formula of this, it's called triple C as well, CCC, cash conversion cycle, right? So inventory holding period plus receivables collection period minus the creditors payment period. This is the formula for cash conversion cycle. So if you want to write this, you can write this down as well.
Yes.
After that, we'll discuss the explanation of this.
Okay, done.
Okay, that's great. Now let's continue. Let's discuss the explanation of this, right? So ideally, businesses would like to have cash tied up in working capital for the minimum number of days possible. So in the case of cash retail businesses, such as a supermarket, the cash conversion cycle will be very short, right? So you can see that the word itself is explaining that what the formula is meaning, right? So cash conversion cycle means that how quickly the cash is being converted. First it's being paid and then how quickly it's being converted back. So it's the cycle, right? So first inventory is purchased. In any business, this three-stage cycle is there. First of all, the inventory is purchased, right? Then after that, we have to receive the cash from receivables so that we can pay the inventory payables, right? And after that, the last thing over here is to basically pay the creditors, right? And once we pay the creditors, then we'll able to purchase inventory, because if we don't pay the creditors, then we will not be able to purchase inventory, right? So everything is
Yeah.
linked over here. So in the case of manufacturing businesses, which also sells on credit, the cash conversion cycle will be considerably longer, obviously, because in retail business, the cash is quickly collected just in 5-10 minutes, right? Or let's say 1 day, right? But in the manufacturing businesses, what happens is they give a credit period of 30 days, 60 days, right? So 1 day compared to 60 days, it's much higher over here, right? So the cash conversion cycle should be, the shorter it is, the better it is. Shorter, the better. Okay, right? And therefore increase the working capital requirements of the business, right? So the shorter the days for the cycle is, it's very beneficial for the company in this case. Okay, right? Now over here it's explaining an example as well, right? Let's read this as well. By way of illustration, suppose that two businesses provide you with the following information relating to working capital management, right? So this is business one, this is business two, right? All of the three information is given: inventory holding period, receivables, and payables payment period, right? Now if we consider this, if we interpret this, if we explain this, let's read what it has written. Business one holds inventory for a relatively short period of time, because you can see it's just holding it for 10 days. The inventory comes it at 1st March, right? And it's completely sold out at 10 March, right? Sales are also made for cash, so there is no receivables collection period, right? So receivable collection period is, it's very good over here, it's 0 days. That means maybe the sales will be made on cash, there will be no receivables over here. That's why it's zero, right? Whilst it also takes 40 days credit from supplier. So originally we can see that business one is on a very good cycle over here, right? Because it has negative 30 days. And I told you the shorter the triple C answer is, the cash conversion cycle answer is, the shorter it is, the better it is. Because you can see 35 days, it's a longer answer. This is the shorter answer. So in this case, business one is better, right? Cash is therefore collected in quicker than it is paid out. By contrast, if we compare business 2 now, so business 2 holds inventory for 30 days. So if inventory comes in at 1st March, it's sold out after a whole month, let's say at 30th March, right? So before it is sold, when credit customers then take on average 40 days credit, right? So they're taking 40 days credit. The total of 70 days is then offset to the credit of suppliers, that is 35 days, leaving a net conversion cycle of 35 days. That means once the cash is gone, it comes back into the business after 35 days, right? And in this case, it's minus 30 days. So that means cash is never gone out of the business. We always have cash available if we talk about business one in this case. Okay, so
So the
this
business one is better than the second one.
exactly, that's right. Because the shorter the answer is of triple C, the better it is. Okay, right?
Okay.
Okay, now finally, let's move on to the last part. And hopefully, this is the last part of this chapter. And this is basically
Oh,
the,
thank God.
yeah, this is just 2 pages are left. And this is the last part that I explained you, the investor ratios, right? It's called financial position as well. Now, there is one new word in this case. I will be explaining you that once we read this. So, when assessing the
Yeah.
financial position of a business, the main focus is its stability and exposure to risk. This is typically assessed by considering the way business is structured and financed. This is referred to as gearing. This is the new word that I'm talking about. Okay, so if you want to understand it in a much easier method, you can understand gearing as the level of debt that the company has, raised in this case, right? If we consider the accounting equation again, asset is equal to capital plus liabilities. In the first case, let's say the company has 1000 of capital, right, and just 300 of liabilities. So in this case,
Yeah.
I can say that the gearing is very low. In this case, gearing is very low. Why is it low? Because the risk of liability is higher in every case, right? In this case, the liability is much lower, the shares and the capital are much higher, right? So the level
Okay.
of debt is dependent upon the gearing level. Gearing usually determines the level of debt, because debt is actually in real life, it's very risky, right? If we are not able to arrange interest just for even 1 month, it becomes very difficult
Mhm.
for us to survive, right? Now, in the second case, let's consider that if a company has 200 of capital and let's say 1500 of liabilities, so there is more risk over here, right? The bank will be always asking us that will you pay our interest, will you pay our interest? So in this case, the gearing will be much higher, right? So this was the explanation of gearing word. It is how the business is structured and financed. And the structure includes two things, right? Capital and liability. So the more the liability we have, the more the gearing we have.
Okay.
Okay. Now the first, this brings me to explaining the first method, the first ratio of the financial position, the investor ratio, which is measuring gearing. How do actually calculate the gearing in a monetary value term, right? So there are basically two ways to calculate this. Now don't worry, you will be given in the exam which way to calculate, but in usual terms, you
Okay.
will be calculating through this method, the first one. Okay, but if the second one is to be used, it will be given to you in the question that you have to calculate using this formula. Okay,
Mhm.
now the gearing is measured as long-term debt divided by equity, because that's what we studied over here, right? If we calculate gearing of this company one, so let's calculate it, 300 divided by 1000. So that means it's only 0.3, or in other words, just 30%, right? Let's calculate it for the second company. So for second company, it's 200, sorry, the liability is 1500 divided by 200, right? So let me calculate the exact answer for this. 1500 divided by 200, so you can see it's 7.5, which is a very high amount. 7.5, right? So that means the more the debt items we have, the more the gearing we have as well. Now the second formula is very similar to the first one. The only difference is that we take long term debt divided by equity plus debt. Okay, the formula is basically debt divided by equity plus debt. This is the formula for the second one, right?
Sorry,
But
just one moment.
yeah, sure.
Um,
In normal cases, you will be asked to just use the first one, the first method.
I hope so.
Yeah.
Oh, it's the same thing, long-term debt. Why?
Yeah, but only the denominator of the fraction. If you look at the bottom of the division sign, it's only different in second case. So
Yeah,
it's
I mean,
equity plus debt.
why is that?
It's just, as a expression of that, right? As a measure, like just we studied the margin, it's just made like different formulas. So
Do we
depending on
have
the
to write
company,
down 0.3 or 30%? How?
it's not, we can write 0.3 as well. We can write 30% as well.